All right, so decision-making techniques, and one of the decision-making techniques is the break-even analysis, which is actually called the cost volume profit analysis, the CVP. Now, from cost accounting, when we are asked to determine total cost, we always say that total cost is equal to total fixed cost plus total variable cost. Now, the question had been that what goes into total fixed cost and what goes into total variable cost? Fixed costs are costs that do not change with time, but variable costs are costs that changes with respect to the level of output. So, in most questions, you realize that fixed cost is fixed for a period of time and changes. So, we had a situation whereby fixed cost changes like rent, electricity, and all that. So, we say that that is a step up or step increase in cost. Now, so how to identify the variables to determine total cost is to look for fixed costs and to find your variable cost. Your total variable cost basically is going to be the variable cost per unit multiplied by the quantity that you're going to sell. Okay. And then so therefore total cost would be the total fixed cost plus variable cost per quantity times fixed cost, which is going to be, let's assume Q VC, or let's call the variable cost per unit X. So you can say quantity X, it is multiplying. Hence, we are going to find break even. What is break even? Break even is a technique where, or it's at the point where our total revenue equals our total cost. So when our total revenue is equal to our total cost, then we say break even has actually occurred. Now, how do we determine total revenue? Total revenue is also equal to the quantity times the selling price per unit. That is what would give you what we call total revenue. So the quantity you are producing multiplied by the the selling price per unit. Okay, so if that is the case, we are going to equate this to total cost and then determine the break-even formula. So it is as a result of this being equated to this, that is how come they came about the break-even analysis formula. So look at it. So we are going to represent selling price per unit by S. And then we said total variable cost is also equal to uh, quantity times variable cost per unit. So let's say variable cost per unit is what? Y. So I have Y and then S. Okay, so QY and then QS. So total revenue, which is Q times S, will give me QS. My total cost, which happens to be um fixed cost, total fixed cost plus what we call um quantity times the variable cost per unit. So QY, we ought to group items. So break even is looking at the quantity you would either sell and the quantity you will spend in order for you to make equal returns. You neither make a loss, neither would you make a profit. That is what we refer to as break even. So the quantity to sell, the quantity to spend on, so that you will not make a loss, nor would you make a profit. So we are here to determine the quantity. So we need to group items. To group items, we have the quantity of the selling price minus the quantity of the variable cost. All is equal to total fixed cost. Okay. Since you are finding quantity, let's make Q the subject. We have Q here, the selling price minus the variable cost, which is equal to total fixed cost. Therefore, quantity will be equal to total fixed cost over selling price minus variable cost. Now, from cost accounting, selling price minus variable cost is always called contribution. It's always called contribution. So when you are asked to find break even in quantity, it is your fixed cost over your contribution. And contribution has always been the selling price per unit minus the variable cost per unit. That is what will give you the contribution. So that is how come they were able to arrive at this formula for determining the break even in quantity per total revenue being equated to total cost. Okay. So at the end of this lesson, you should learn a lot from the course. So I would skip this assumption, which I would expect you to learn, because one of the years, a question had dropped on write 5 of the assumptions behind the cost volume profit analysis, which states that all costs can be resolved into fixed costs and variable costs, just like we looked at. Cost can be grouped into fixed cost and variable cost. And then it says that fixed costs will remain constant and variable costs vary proportionately with activity, just like we proved that fixed cost is constant for a period of time, but variable cost changes with respect to output. Over the activity range considered, cost and revenue behave in a linear function or fashion. It means that cost and then revenue must be equal. That's the only factor affecting cost and revenue as the output or the number of quantity you are producing. That is the revenue. So that these are all assumptions we make in cost volume profit analysis. So the fourth one or the fifth one is saying that technology, production method, and efficiency remains unchanged. Then particularly for graphical method, that the analysis relates to one product only or to a constant product mix. So we'll be looking at product mix where you are producing two or more items in a firm, and then also in a situation whereby you are producing just a single item in a firm. So they are saying that when you are using the graphical method, um, the CVP analyzes just one product or a constant product mix that you have within the firm. And then there's another assumption behind the cost volume profit analysis is that there are no stock level changes or that stocks are valued at a marginal cost only. So there are no changes in the stock level. And then marginal cost is going to be the previous year minus the current year stock. That is the difference, is what we call the marginal cost. So the marginal cost in last year's price and this year's price will give you a difference. So the same thing for the next year and then the current year you are would also give you a difference. These are some of the assumptions and what can we use cost volume profit analysis for? We can use it for short-term planning. We can explore the relationship which exists between cost, revenue, output levels, and profit. It can be used for the choice of sales mix to actually engage in. It can be used for pricing policies. It can be used for profit planning. It can be used for sensitivity analysis, and it can be used for special order acceptance. So when there is an order from a customer, the material that you are going to use against how much you are going to charge. You check if you use this material to produce it, are you going to make a loss or not? And that is what is going to inform you as to whether to go ahead and accept the order or not, which will be looked at deeply when it comes to relevant costing, either to make or buy, either to go and then make the item yourself as a firm or ignore. Okay, so these are some of the theoretical items you need to know under your cost volume profit analysis. So cost volume profit analysis utilizes two types of input for calculation of cost, the fixed cost and the variable cost, just like we looked at. Total cost and total revenue. Total cost and total revenue. Total cost is the sum of the fixed and then the total variable cost for the production or construction. So that is what I wrote in the initials. So total fixed cost plus total variable cost would give you what we call total cost. And total revenue is the product of expected unit sales and then the unit price per each. So total revenue actually is equal to the quantity, that is the expected unit, times the selling price per unit, times the selling price per unit. That would give you the total revenue. Okay, now, determining the break-even point. The break-even point. This is the break-even point as the point at which a business neither makes a profit nor a loss. At that point, total revenue equals to total cost, and that is what I proved in the initial discussion. The dynamics of the computation of the break-even point are explained below. You can use three methods in determining the break-even point. 1, the mathematical method. 2, the contribution method. And 3, the graphical, which is the chart method. At your level, they are all required for you to know. And these are the same things if you go to the master's level, you'll be taught. So you'll be taught the same thing if you are doing or pursuing your master's. Okay, so what is the mathematical method? That is what I proved for you. Total revenue being equal to total cost, knowing the variables that constitute total revenue, and knowing the variables that constitute total cost. And at the end of the day, you would have what we call your quantity being equal to fixed cost over the selling price minus the variable cost. Okay, now, after knowing that, the next is to know the contribution method. And the contribution approach is always determining selling price minus variable cost being the first item, which is the contribution. So a number of methods for the contribution is that when you are asked to determine break-even in points, quantity or the unit to produce, it is always the fixed cost over the contribution per unit. The word is contribution per unit. So you can be given total variable cost. You can be given total sales. You need to divide them by their respective quantity to determine contribution per unit. That is when you are finding break-even point in unit, BEP in unit. Okay, so this is under the contribution approach, a number of formulas you need to know, and that formulas will be using them regularly. Okay, so we can also be asked to find break-even in sales. That is after you have determined the unit, just multiply it by the selling price per unit. That is break-even in sales. So after determining fixed cost over contribution, multiply it by the selling price per unit or the sales per unit. This would help you determine what we call break-even in sales. Please, the first is break-even in units without multiplying it by the selling price. The next is break-even in sales by multiplying it by the selling price. Another way of determining break-even in sales is to write 1 over your contribution per sales ratio. Contribution per sales ratio multiplied by fixed cost. Now, be mindful. Be mindful that we can be asked or we can be given in the question contribution per sales ratio. You are not going to use this formula to determine the break-even in sales. When the question gives you contribution or gives you sales minus variable cost, you can go ahead and use this. But then the question can state that the contribution ratio in the question is 4. Please, when you're asked to determine break-even in sales, you are supposed to use that contribution per sales ratio. Now, how do we arrive at this contribution per sales ratio? It is basically your selling price minus your variable cost all divided by the selling price. That is what we call the contribution per sales ratio, contribution per sales ratio, after which you multiply by 100. That is what will give you your contribution per sales ratio. Fixed cost is always given you in the question. It is one question that we all saw together, and then we were determining the fixed cost component of the question, and we were determining the other component of the question. So I always say that it is not as easy as you see it, and then what I just told you, but then you need to solve more questions to come across a lot of questions before you can tell yourself you are really abreast with whatever that have been given you. Okay, so just under the contribution approach, we have looked at break-even point in units, and then we have also looked at break-even point in sales. In sales, we said that fixed cost over contribution times selling price per unit, or you can have fixed cost. It can be fixed cost over the contribution per sales ratio. So FC over CS ratio, and I'm showing you how to arrive at the CS ratio. To arrive at the CS ratio, it is just the selling price minus the variable cost, all divided by the selling price by 100. Any question, please? All right. Please, if you want to ask a question, put up your hand so that I will call you, because I have actually muted everyone so the class can be in uniformity. Or you can chat, send a message in the chat box. I'll read it and then I'll respond. Thank you. Okay. Let's continue. So the next one is to determine contribution ratio, which I've already explained, which is contribution over the selling price per unit multiplied by 100. This one that I have written here. Okay. So we said is the selling price minus the variable cost, which will give you contribution over the selling price multiplied by 100%. Okay. So the next item is to look out for the level of sales to result when targeted profit is given. So break even in point or break even in units. The same thing. When I say point, break even point in units, when targeted profit is given, is equal to fixed cost plus targeted profit over contribution. So it's the same formula, but this time around, targeted profit has been given you. So you are supposed to determine BEP in units when TP is given you. So targeted profit is the TP when TP is available. So it's equal to your fixed cost plus your TPs all over your contribution per unit. And I believe we can all solve contribution per unit, so we don't have much problem with whatever we have. Okay. All right. So that is for break even in point or unit when targeted profit is given you. Okay. So the next one is to find break even when targeted profit is given after tax. Now, this is one of the bit dicey thing that you always do. When your targeted profit given you must suffer tax, you must always less the tax rate in the question from 1 and then divide targeted profit by it. The fixed cost plus targeted profit over 1 minus the tax rate, all divided by the contribution per unit. Are we together? All right. So know when to use the formula. Okay. Then the next question says that when targeted profit is given you, and then you're asked to find sales, not the units, whatever you get for the targeted profit, which is this place, multiply it by the selling price per unit. So look for the selling price per unit in the question. So this is in units. Once you multiply it by the selling price per unit, then you have changed it for break-even point in sales, meaning you have changed it to break-even point in sales. So fixed cost plus targeted profit over contribution multiplied by the selling price per unit. Okay. So these above formulas actually explains the contribution method that we are looking at. And more often than not, that is what we use. We use the contribution method a lot. We use the contribution method a lot. Okay. No questions. No questions. So let's read through this question together. Let's read this question. A company makes a single product, which with a sales price of 12, I don't know if it's pounds or it is euro, and a variable cost of £9 or €9. Fixed costs are 120,000 per month. Then the company budgets to sell 90,000 units of the product a month. Calculate A, the number of units to break even. So here, you and I can actually tell the formula by saying break even in points. So you write the formula, please. Break even in points. Then you write units because it says the units, the number of units. Okay. Then you write your formula, which can attract max. So fixed cost over selling price minus variable cost. You can choose to write contribution so that you come and determine contribution on the lighter side. So we have 120,000. Please, I don't have my calculator with me. So if you do, kindly do that for me. So the selling price, this is the selling price, and this is the variable cost. It was too clear in the question. And this is the fixed cost. Okay. So we have 12 minus 9, which is 3. So break even in units is going to be what? 40,000, if I'm not mistaken. Kindly confirm, please. 40,000. Okay. Thank you. Now, it becomes easy for me. This is in units, please. So write it unit 40,000 units because that is the requirement of the question. Now they are saying sales at break-even point. So here they are asking you to find BEP in sales. BEP in sales. As smart as you are, it is the same break-even point in unit multiplied by the selling price per unit. That will give you break-even point in sales. So here, if it is examinable, you can go ahead and repeat the whole formula and multiply it by the selling price. But because of time factor that we are learning, I'll just pick the break-even point in unit and multiply it by the selling price. Who is confused? No one is confused. Okay. So I believe we can go ahead. So I have the 40,000 by is it euro or pounds? Those who are good with currencies. Some of us have not traveled before. So please you do multiply this, and then I think it's going to give me, in terms of currency, 48 or 480,000. Someone confirm, please. 40,000. 40,000 times 12. 480,000. Okay. Please, if you have a question, try and ask a question. Okay. Don't let us move on because the more we go, the tougher it becomes. Okay. Someone says it is pounds. Thank you. From hence, I'll say pounds. So 480,000 pounds. What I basically mean from here is that someone can repeat the formula fixed cost over selling price minus variable cost, or multiply by selling price. Now, we know fixed cost over contribution is supposed to give us the 40,000 multiplied by the selling price of the 12 pounds, which will give us the 480,000. So directly, once I've been able to determine break-even point in units, I can just go ahead and multiply it by the amount and then find my point. Now, can we use the contribution um, ratio method to confirm it? Can we use the contribution ratio to confirm it? Okay. So they are telling us that it is fixed cost over the contribution ratio. How do we determine contribution ratio? We said it is the contribution over selling price times 100. Okay, times 100. Now, what is contribution? 12 minus 9 over 12 multiplied by 100. Can someone please confirm for me? What do you have? 25%. Okay. Now, if it is 25%, using the contribution ratio, it says that 1 over the contribution ratio multiplied by the fixed cost of, what is the fixed cost? 120,000. So what is 120 divided by 25%? Are we getting the same answer? Are we getting the same answer? Okay. If that is the case, it means that that formula also works out. So whichever formula that you are choosing for the break-even sales, either the contribution ratio format or whatsoever format that you have, it works out. Okay, let's go ahead. The next one says we should find the contribution per sales ratio, which we've already determined, right? The C says we should find contribution per sales ratio, which is the 25%. I believe you're okay. Yes, ma'am. Please, who says I'm seeing a different answer with respect to the sales? It says that getting 404,800. Please do it well. This is not just 25, it's 25%. We multiply by 100% to get in terms of percentage. So 1 divided by 25% multiplied by 120,000 should give you 480,000. Should give you 480,000. All right, so we've already determined the contribution per sales ratio, which is the contribution over the selling price or the sales multiplied by 100, and we had 25%. So here we can boast of saying that we have our 25% intact. Now they're asking me what's the budgeted profit per month? Who can tell us the budgeted profit per month? Who can tell the budgeted profit per month? So the company budgeted to sell this. So if the company budgeted to sell this, How do we arrive at profit? Profit will be total revenue minus total cost. And we said revenue is equal to what? Yes, total revenue is equal to what? Total revenue is equal to the quantity multiplied by the selling price per unit. And per our question, the budgeted quantity is 90,000 and our selling price per unit is 12. So 90,000 times 12 will give us our revenue. 90,000. Please, what do we have? 90,000 times 12. What do you have? Then you now determine total cost. What do you have? $1,080, 1,080,000. Okay. Then total cost, like we know, is equal to total fixed cost. And someone asked the question, total fixed cost plus total variable cost. And we know total fixed cost, according to our question, is 120,000. How do we determine our total variable cost? It's the variable cost per unit, which is the 9 times the quantity of the 90,000 units. So 9 times the 90,000. Please, in total, what do we have for total cost? $930,000. 930,000. Can we determine our budgeted profit now? This is our revenue. This is our cost. What is our budgeted profit? Can someone tell us our budgeted profit? If this is our total revenue and this is our total cost, and we know profit in natural sense is total revenue minus total cost. If revenue is this and then cost is this, what can we say about our profit? What is our profit? $150,000. Okay, thank you all, especially to those providing the answers. So this is our budgeted profit per the month, and we have been able to determine it. Is anyone confused? Because you're making progress. Okay, what number of units, be mindful, will need to be sold to achieve a profit of 20,000 per annum? Don't forget that to break even in point when targeted profit is given, when TP is given, in terms of units, we said it is going to be the fixed cost plus the targeted profit all over contribution. And our first cost was 120,000. So 120,000. Our targeted profit was actually 20,000 over our contribution. What is our contribution? Our selling price minus our variable cost. What do we have? We have 140,000 over 3. So what will be your targeted profit? What will be your quantity to produce when targeted profit is given? 140 divided by 3. 4667 units. I believe you can do justice to the next question. So 46,667 units. It is asking you the level of sales when targeted profit is given you. So it is the same formula, just multiply by the selling price. So whatever you've determined as the unit, multiply by the selling price. So 46,667 by the selling price of 12. Please, what do you have? 500 and 560,004. Okay. So this £4. Please be writing the unit measures and all that attached to it. So here the profit would have been in pounds, 150,000 pounds. Okay. The last one under this question, the last but not the least. Okay, so this is last but what? Two. Last but two. Last but two. If taxation rate is 40%, how many units will need to be sold to make a profit after tax, or the profit after tax is 20,000 per annum? So the same formula, but this time around, it is going to suffer after tax. The same format, but it's going to suffer after tax. So we have fixed cost plus targeted profit divided by 1 minus the tax rate, or divided by the contribution. So we have fixed cost of 120,000. Please don't leave even if you know this basic one, because this is just a warm-up to go and do the deeper ones. I've seen some people dropping off already. 20%, 20,000. The tax rate is 40%. So I have 1 minus 40%. Now, all what you're doing is to determine this contribution format for a single product. We will be going to the multi-product, and that I will need you to pay attention. So I just can't pick the multi-product without first explaining a single product to those who have actually forgotten. All right. So 120,000 plus 20%. So first, I advise people or students to solve this one. 20,000 over 140,000, 1 over 1 minus 40%. Whatever answer that you get, you add it to this, and then you finally divide by 3, and then you have your final answer. So I'm leaving a final answer for you to determine. Okay. Now it says because of increasing costs, the marginal cost is expected to fall to 6.50 per unit and fixed cost to 70,000 pounds per month. You are supposed to determine break-even in unit. Hello? Okay. So here, they are just telling you that marginal cost, another name for marginal cost is the variable cost. So variable cost, which used to be 9, is now falling to 6.5. But sales is the same. But then fixed cost had also changed. So usually fixed cost over sales minus variable cost. What do we do then? Fixed cost has now changed to 70,000. So I have 70,000 over the sales of the 12 minus the variable cost or the marginal cost of 6.5. Now you are supposed to determine BEP in units. Is it difficult? Single product. Is it difficult? All right. So I don't think anything here is difficult for us to be challenged to solve. So I believe you can produce the answer to H. Now, how about I? It says if the selling price cannot be increased, what will be the number of units required to maintain a profit of 20,000? So this remains. They have introduced a targeted profit. So 70,000 unit fixed cost plus our targeted profit of 20,000 divided by 12 minus 6.5, and that will give you the I. All right, so we've done due justice or due diligence to this particular question from there. So it says that the margin of safety indicates by how much sales may decrease before a loss will occur. Using the example that have been stated in this question, where the unit selling price and the variable cost were this and this, respectively, the first cost were this, you can actually solve it. Let's go here. It's the same thing I'm going to teach you right here. Okay, so let's come here. Margin of safety. Okay, so this is it. So margin of safety, it indicates by how much sales may decrease before a loss occurs. So the same concept, you realize that the same slide was picked from the book, 20 and 10. So it's nothing different from what I'm telling you. Okay, so this explains what margin of safety is, which I'd wanted to show you in the chat. So after the question, we are going to draw this chart. So this is the representative of the break-even point. You always know that total fixed cost will not start from point zero. This is point zero, where the two lines meet is point zero. Now, total fixed cost would never start from zero. So fixed cost will never, once fixed cost will not start from zero, it means that your total cost line cannot start from zero. Will start where the fixed cost starts because total cost has a component of fixed cost in it before the variable cost. Okay. So since or because we have that constituent in it, your total cost line has never started from zero. Okay, so since our total cost line has never started from zero, sales would always start from zero because sales varies with respect to output. So sales will start from zero and hit the highest. Now, where total cost line intersect with total sales intersect with total cost, that is when the break-even point is. Guys, a minute. All right, so where total cost line intersects total revenue line, it forms the break-even in point. Okay, now at the highest of your profit to the where the break-even line is what we call the margin of safety before sales begin to decrease. So this portion is called the loss. Anything below the break-even point is referred to as loss, and anything above the break-even point is referred to as profit. So if you're not breaking even and then your sales is greater than your cost, you are going to make a profit. When your cost is greater than your selling price, you are eventually going to make a loss. So the difference between where the break-even point is and where your sales highest point of sales is, that range is what we call the margin of safety. The margin of safety. Okay. So the margin of safety is between the highest sales you've made to the point of break even. We refer to as margin of safety. Now, from 0 to where the total fixed cost line is called fixed cost. I am explaining this because of a purpose. It's called fixed cost. Then, between the fixed cost line and the total cost line, we call it the variable cost. So the variable cost plus the fixed cost should give us the fixed total cost line. And the difference between the total cost line and then the sales revenue line is what we call the profit. Please capture this diagram very well because you are answerable to questions from this diagram. Okay. So, if that is the point I am trying to explain, now margin of safety. Yes. All right, all right. So, the margin of safety has a formula. The margin of safety.
So I cannot do.
All right, so margin of safety. Margin of safety basically would be your budgeted units, and so this is it. The question, you can read the question for the diagram. So I'll share the question with you. So the margin of safety has a formula which says the expected sales minus the break-even sales all divided by the expected sales. Okay, so they'll give you an expected sales in the question. And when you determine your break-even sales, you less it from the expected sales and divide it by the expected sales in a question, and that will give you your margin of safety. Now, margin of safety can either be in terms of value or in terms of percentage. So be careful. Margin of safety can be asked in terms of value and in terms of percentage. So margin of break-even point in units, expected sales in units, then you find the difference and then you write it over the expected sales multiplied by 100. But when it comes to percentage, this is in terms of units. So you see, final answer will be units. But when it says percentage, the final answer must be multiplied by 100%. So if we were asked margin of safety, not percentage of margin of safety, would have been just this one, just the numerator. Expected sales minus break-even sales, that is margin of safety. But when they say percentage margin of safety or margin of safety in terms of percentage, then you need to divide the margin of safety itself by the expected sales and multiply by 100%. So margin of safety in itself is expected sales minus break-even sales. Expected sales minus break-even sales. Expected sales minus break-even sales. Okay, so let's read the question. It says, where unit selling price and variable cost of ticket is 20 and £10 respectively, and fixed costs are 60,000 pounds, we will have a break even at a point of 66,000 ticket or 120,000 sales value. Do you agree? So fixed cost is 60,000. Our contribution would have been 20 minus 10. Our break even in terms of units would have been what? 6,000 units. 6,000 units. Okay. Therefore, our break even in terms of value would have been the 6,000 units multiplied by the selling price per unit, which is the 20. Hence, we would have 120,000 pounds. That becomes the break even, this one. And then this one becomes the break even. Now let's follow up. It says if sales are expected to be 8,000 tickets, or 160,000 pounds, the margin of safety will be. So you see the margin of safety in actual sense, they didn't say percentage of margin of safety. They said the margin of safety could be the budgeted or the expected minus the break even. The break even is 66,000. The expected was 8,000. That would give us the 2,000 in terms of ticket units. But in terms of value, your break even was 120,000, and then your expected is 160,000, giving you 40,000. That is margin of safety. But when you're asked to express it in terms of percentage, this 2,000 would have been written over the 8,000 multiplied by 100 because it says expected minus break even over the expected. So you see, alternatively, we can express margin of safety in percentage form. So it would have been the 160,000, which is the expected, minus the break even of 120,000 over the 160,000 times 100. Then we can have 2,000 tickets over 8,000 tickets multiplied by 100, which is also going to give you the 25%. So margin of safety can be in terms of percentage and can be in terms of value. And it is also referred to as by how much sales may decrease before a loss occurs. By how much a sales will decrease before a loss occurs. Okay. So without much ado, let's go and then tackle the multi-product approach. Multi-product approach. Now, this one follows some steps, and then if you miss one step, you get the whole product wrong. It says, organizations typically produce and sell a variety of products and services. So you don't sell a single service or you don't do a single product. To perform break-even analysis in a multi-product organization, however, a constant product sales mix must be assumed. A mixed product must be assumed. We have to assume that whenever the X units of A are sold and Y unit of product B and Z unit of product C are also sold. Such an assumption allows us to calculate a weighted average contribution per mix. The weighted average or the weighted being on the basis of the quantities of each product in the constant mix. The unit contribution of the products that helps or that makes up the largest proportion of the mix has the greatest impact on the average mix. Average contribution per mix. So to be able to find multi-products, these are the steps that you need to follow. The 5 steps that you need to follow. You first need to determine their individual contributions. Then you come and determine what we call the contribution per the mix. Then you find what we call the average or the weighted average contribution. Then now you come and determine your break-even point in units. Then you go ahead and determine your break-even point in sales revenue. The most important point is this point and this point. Once you mix them, you cannot get this correct. You cannot get this. For this one is the usual thing that we are doing. All right. So can someone read this question? Beacon Limited produces and sells 2 products, money and nanny. The money sells for 7 cedis per unit and has a total variable cost of 2.94 Ghana cedis per unit, while the nanny sells for 15 cedis per unit and has a total variable cost of 4.40 per unit. The marketing department has estimated that for every 5 points of this is very important this is going to be used for the weight or the mix. For every 5 points of money sold, 1 unit of nanny will be sold. The organization's fixed cost total 123,600. 123,600. Okay. Now, what are they expecting us to do? they are expecting us to find a break even in point and then a break even in sales. Now we can't find a break even in point for a product mix. So we need to determine first their individual contribution per unit, which we've already discussed. You can find the individual contribution. So what will be for money? Contribution for money. Contribution for money. His selling price is 7. His variable cost is 2.94. What will be his contribution for money? Money product. For money. Yes, for money. A. C for money will be just the 7 minus 2.94, please. That is all I'm asking you to do. So let me do them here for you. So for money, we had what? 7 cedis minus 2.94. Please give me final answer. And for Nani, we have 15 minus 4.4. Yes. Anyone to provide the answer?
So for money is 4.06.
4.06. Thank you. And for Nani, should be
10.6.
10.6, right? Now, that is the first step. The next step says that determine their contribution per mix. Don't forget that the mix of product X times the contribution and the mix for product N times the contribution is what we are talking about. Okay. Now, how do we arrive at this? We said that for money, 5 units, for Nani, 1 unit. So you need to multiply their 1 by 5 by their contribution that you have determined. So for money, this is for M. M is representing money. So his mix is 5 multiplied by the 4.06. Okay. And for Nani would also be 1 times his contribution that you've been able to determine, 10.6. Please, are you seeing it? What do I have for money?
20.3.
20.3.
3.
And what do I have for this one?
10.6.
10.06. 10.6.
Yeah.
So in total, please, what do I have?
30.9.
30.9. Please, who is lost? Let me find you soon. So you find their individual contribution mix. You find their individual contribution, then you proceed by finding their I believe you don't have a question to ask because you all understand. All right, so let's proceed to the next step, which is step 3. It says calculate the average contribution. So it says the contribution per mix divided by the total mix. The contribution per mix divided by their total mix. So if I pick that of M, it is this one divided by the total. Then if I pick that of N, it is his contribution mix divided by the total. That is why I did it one after the other. Okay. So if I pick for M, his contribution mix, his weighted average contribution would have been his 20.3 divided by the 30.9. And for the N would have been his 10.6 over the 30.9. Please, do you agree with me? Do you agree?
Yeah.
Can I get a yes from like 2, 3 people?
Yeah, we agree.
Okay. One person agrees. Yes, any other person.
Yes, please.
2, the next person. They will be fair to everybody, leaving those who did not agree behind. Okay, I think I can see some two text. All right, so after this, the fourth step says what? You can now go ahead and calculate their break even in units. So let's go and find their break even in units. First cost over the weighted average contribution per unit. So if I pick for M, I pick the first cost and divide it by I pick the first cost and divide it by the weighted average. So contribution per mix divided by the total. This is what you have here. 20.3 over 30.9. What do you have?
We have 0.66.
Please come again. Come again. You are going fast.
0.66.
6.6.
Yeah.
Okay. Please be confirming your colleague's answers, because I don't have a calculator to confirm for that. Then this one, please.
0.34.
0.34. Is that right?
Yeah,
Yeah.
please.
What can you see? If you sum them up, what can you see? What are you getting?
1.
Are you sure? Is
Yeah.
everybody getting the one?
Yeah.
Is anybody getting anything else apart from the one? Okay. So, weighted average contribution per mix divided by. So we now find a break-even point in units. That is finding the first cost over your weighted average contribution per unit. So then each product will be multiplied by their mix divided by their break-even. So let's go and then find the contribution. So the first cost basically is here in the question 1236. 1236. So you divide each by this one that you found here. So for M, you can easily tell his break even by dividing it by the weighted average. Then for N, you divide it by this two as well. So 1236 00. This is 1326 divided by 0.66 for M. Then for N, it is going to be the same 1236 divided by the weighted average of 0.4. Is it 34? 34. So you need to write out the final answer. This one. I want to confirm the first course. 1236. Okay. So what do you have for break even for this, break even for that? Whatever you have as an answer, you multiply it by their contribution mix, which is the 5 and 1. The 5 and 1. 5 units, 1 unit. Then you get your break-even in terms of units and in terms of revenue and in terms of units. So the unit, this one will be multiplied by the selling price of each of the items. So here, this answer multiplied by the 5 units, this answer multiplied by the 1 unit. Whatever that you have, you need to multiply by the sales value for the respective items. So this one sales value was somewhere around 9, and this one sales value was somewhere around 15 to give you their break even. So we'll pick a nice question and then we'll solve it together. But then this evening, it's already 9 p.m. 1 hour, 30 minutes is good for you to consume. So you can attempt this part of it again and then see if you can make a headway. But I will pick a beautiful question on the two and solve it together. Now, that question that we'll pick will be from your mid-sem. Okay. So this is a mid-sem question that was given to them to solve. And that is what we'll use for studies in our next meeting. Okay. Now, it wasn't an easy to go question. Why am I saying that? The components were split, and we were supposed to determine each and every component from this question. So it was a split component, and then we need to put them together before we can go ahead and solve them. Why am I saying that? I want a reader to read this question.
Should I go ahead?
Oh, yes, sir.
So we have Things Entertainment.
Mhm.
You are the management accountant of Things Entertainment, a Ghanaian event organization and talent management company which promotes concerts at locations throughout the world. Currently, management is examining the viability of a concert dubbed Outlawed at the O3 Arena in Takoradi. According to the head of events, the O3 Arena will cost 200,000 Ghana cedis to book for one night. This does not include a cleaning fee of 18 Ghana cedis per attendee, chargeable after the event. Additionally, the artist booked will take a total of 300,000 into bracket non-negotiable upfront to perform on the night. This includes the transportation and the hotel fees of the artist. The marketing manager estimates that 40,000 is needed for all the marketing and advertising. In order to attract attendance, a partnership has been sought with Akpet Distilleries to provide a bottle of spirit which costs 50 cedis with each ticket. Akpet is willing to bill you with only bottles served and does not require a down payment. The security arrangement for the 10,000 capacity arena is 30,000 for the night. The head of events proposes that a ticket should be sold at 170 cedis. Based on the information provided above, complete the report below to be presented to management as your analysis of the proposal. Run off your final answers to the nearest phone number.
And
Thank
that
you.
form, is it on the ground?
No can count, I said.
Thank
No,
you very
no,
much
no,
for
no,
that.
no, no.
It is not on the ground.
And
If it
easy
is,
grand form.
if it is on the ground, like we have take it and clean it.
But he has not even indicated what we are even calculating for.
Okay, let's go. What you are supposed to calculate for? Let's go. Dear team, I have spent some time interrogating the data on the proposed concept and have come to the conclusion that whilst it is a good PR move, some important financial considerations are necessary before we make commitment. Since our contribution to sales ratio is, how do you determine sales contribution ratio? Let's go. The formula. Sales contribution ratio, formula. Sales contribution ratio. Contribution over what? Selling price times what?
Oh,
100%.
but I thought you said it would be 70 tomorrow. Nah.
Wait. Oh, I wanted to do some introduction.
Okay.
Once,
We beg
once I do
you.
the introduction, I think when you pick the question and then we come back, you'll be able to answer it. Okay, it says
Mm.
that you need to pick out all the ingredients. You need to find out what constitutes your variable cost, what constitutes your fixed cost, what constitutes sales, what will constitute um how do we call it? Yeah, so these are the things you need to find for. So imagine that you are going to rent an event space, and then they are telling you that that night you are supposed to pay 200,000. Is it fixed or is variable?
It's fixed.
Okay, so one item for fixed gone. So we have fixed, one item for fixed. Now they are saying that this does not include cleaning fee, 18 cedi per attendee. So what type of cost will be this one? This changes with respect to attendees. So what type of cost will be the 18? Can someone guess? What type of cost is the 18?
It's a variable cost too.
Thank you. Variable cost, so VC. So one variable cost noted. Additionally, the artist book will take a total of 300,000 upfront, non-negotiable. What can you say about the 300,000?
It's fixed. It says it's
It's
non-negotiable.
fixed.
Fixed. Thank you. So we are just writing the items down. The marketing manager estimates that 40,000 is needed for all marketing and advertising. What type of cost is this one too? So Adumayo Bebre, it is not going to change. That is what he's estimating for the period we are going to advertise for that particular item. So in our advertisement, we are charging 40,000. It is not changing with respect to the number of people that are going to attend the program. The cost is not changing with respect to the number of attendees to the program. Okay. Then it says that you partnered with Akpet Distilleries to provide bottle of spirits, which cost 50 cedis with each ticket. With each ticket. So what can you say? The 50 cedis per the spirit is also what? A variable what? Cost. Because it's going to change with respect to what? Output. Now, Akpet is willing to bill you with only bottles served and does not require a down payment. The security arrangement for the 10,000 capacity arena is also taking 30,000 per night. So this cost is also what? A fixed what? Cost. Are you with me? Now, they don't need to tell
Yes.
you the number of bottles they are going to supply because they told you the quantity that is going to occupy the arena, 10,000. So they are supposed to supply how many items? 10,000. The cleaner is also going to clean based on how many number of people? 10,000. So the 10 capacity here becomes the what? Quantity. Do you have a fair idea now?
Okay.
So the 10,000 here becomes the quantity that is expected to come. And then your sales, you are going to sell ticket for how many people? 170 for how many people? 10,000. So contribution per sales ratio, what is our total variable cost? Our total variable cost is the 18 for the cleaning and then the 50 for the distilling. 18 plus 50 will give me what? Total VC will be 18 plus 18 plus the 50 cedis, which is what? 68, right?
Yeah.
If
Yes.
that is the variable cost, how do
Per
we
unit.
determine contribution over sales times 100%?
Boss, that
Yes,
is the
ma'am.
variable cost per unit.
Yes, variable cost per unit is the variable cost for the cleaning and the variable cost for the distilling that they are going to supply. That will give you your
Yeah.
total variable, the variable cost per unit, sorry.
Okay.
Now, variable cost per unit, sales is 170,000. Can you determine your contribution per sales ratio now?
Mm,
Can you? 170 minus 68 divided by 170. What is the final answer? Don't be lost in thought. Contribution is basically selling price. Here. So here is the selling price. They said
hey,
sold.
this thing, if we do it tomorrow, like fine.
So 170
Yeah, bro.
and minus 68 over 170 by 100%. So you see, when I was just giving you the formula, someone will say, now so this is the ordinary break even that we know from our HND level, the normal break even that we've known all these years. But trust me not, this is not the usual break even. This has to do with critical thinking.
Complex information.
Thank you, boss.
We'll
So this
solve
is
it tomorrow.
this is not AI generated. This is someone Obina kind of rough is here. I say compress. And I next one I can if you come as into compress. I say how.
Compress.
Disclaimer. So please, what do you have? How many percent do you have? 170 minus 68 over 170. May try answers. Will be a answer.
That's 60%. Oh.
That's 60%. Okay. So do you agree with B to C for providing 60% for the first question?
Mm,
And I 18.
that's correct.
And they ask you, since our sales contribution to sales ratio is 60% and our
Hey, I thought
total
we are doing it tomorrow. And I asked 30. And I said,
and
maybe in it.
and our total fixed cost is, now we've been able to write out the total fixed cost. Now let's go and pick the total fixed cost and add them. 200,000 plus 300,000 plus 400,000 plus 40,000 plus 30,000. Total fixed cost I say
200 plus 300, 500, 530.
570. Would you agree with me that 570 will be my total cost? Total fixed cost. We have non-negotiable artist booking. We have the rental of the arena, marketing, and then we also have the security guards fees. 200, 300, 40, 30. Pacho be saying. Tell
And
us
on
your
one
carry
side.
old girl in phone go give out. Yes, so as much as I agree with me, yes, I do. Yes, I do. Okay, please, Yamfa de can introduce go and read the question. The question they are not shared. So you can decide to take a screenshot and take a screenshot. But chichamu question na mumba class ta. In our next meeting, mumba. Because of muntia na mumbra mumba. So please we'll continue. The question doesn't end here. Oh. It goes ahead and talk about the tickets being split into VIP and then regular. So the ticket of the 10,000 capacities is now split to 2,000 seating for VIP and 8,000 seating for VVIP. The question is there, it has not ended though. We've not even treated half of it. And this chart, don't forget, I told you to look at the chart very well. Oh. Where the points meet, above it is profit, beneath it is loss, fixed cost, total cost. I asked you to look at it very well. From here to here would have been a margin of safety. And then see, you So me, I am done explaining mine to you. We shall continue when we have to continue. See you guys. Have a blessed evening. Anyone to pray with us before we close?
Please, uh,